Everyone in America is talking about which stocks to buy in 2026, but almost no one is warning you about the US stocks that could quietly drain your wealth. These are 8 US stocks you must avoid in 2026. And number 1 is one of the most popular stocks in the United States right now. That's what makes it so dangerous. Let's start from the bottom and work our way up. Number 8. Walgreens Boots Alliance. Walgreens looks like a safe bet. It's been around forever, it pays a dividend, your parents probably bought aspirin there. But here's what the quarterly reports won't tell you in plain English. The entire pharmacy retail model is collapsing in slow motion. Walgreens is closing hundreds of stores, not because of bad management, but because the math stopped working. Pharmacy benefit managers squeeze them on prescription margins. Amazon and online retailers undercut them on front-of-store products. Real estate costs keep climbing while foot traffic keeps falling. The dividend yield looks attractive at first glance, over 10% in some recent periods. But high yields on struggling companies aren't gifts, they're warning signals. When a stock price collapses and the dividend stays constant, the percentage climbs. That's not generosity, that's unsustainable. Walgreens cut its dividend in early 2024 for the first time in decades. The business model that worked for 50 years doesn't work anymore, and no amount of transformation strategy changes the fact that you can get prescriptions delivered to your door for less money. Number 7. Bath & Body Works. Walk into any mall in America and you'll smell Bath & Body Works before you see it. Candles, lotions, fragrance mists. The brand has loyal customers, but loyal doesn't mean growing. The company grew explosively during the pandemic when people were stuck at home buying scented candles and hand sanitizer. Revenue peaked, then reality returned. Now they're facing a problem that sounds simple but is actually existential. Their core customer is aging out, and younger buyers aren't replacing them at the same rate. Gen Z doesn't shop at malls the way millennials did. They don't impulse buy body spray at the same frequency. Bath & Body Works tried to pivot online, but so did everyone else. The digital space is crowded, competitive, and expensive to operate in. Customer acquisition costs are rising while average order values stay flat. The company is still profitable, but growth has stalled, and in the stock market, stalled growth in a discretionary retail business means your capital sits dead while inflation erodes its value elsewhere. You're not losing money dramatically, you're losing it slowly, which is worse because you don't notice until years have passed. Number 6. Moderna. This one surprises people. Moderna became a household name during COVID. The stock went parabolic. Early investors made fortunes. The mRNA technology seemed revolutionary. But here's the uncomfortable truth. Moderna is essentially a one-product company, and that product's demand is evaporating. COVID vaccine revenue is collapsing. In 2022, Moderna brought in over $18 billion. By 2024, analysts projected that figure could drop below $6 billion. That's not a correction, that's a cliff. The company is burning through cash trying to develop other mRNA-based treatments. Some might work, most won't. Drug development is expensive, slow, and has a failure rate above 90%. Moderna is betting its future on a pipeline of candidates that may or may not reach the market in 5 to 10 years. Meanwhile, the stock still trades at a valuation that assumes future blockbusters are guaranteed. They're not. The market is pricing in hope, not probability. If you're holding Moderna in 2026, you're not investing in a pharmaceutical company with diversified revenue. You're speculating on experimental science with your retirement account. Number 5. Beyond Meat. Plant-based meat was supposed to be the future. Beyond Meat was supposed to lead the revolution. The pitch made sense. Healthier for you, better for the planet, appealing to a generation that cares about sustainability. The stock debuted at $25 and hit $234 within months. Then people actually tasted the product. Long term. It turns out that novelty and habit are two different things. Consumers tried plant-based burgers. Some liked them. Very few made them a permanent replacement. Sales growth collapsed. The stock followed. Beyond Meat is now trading below its IPO price, and the business has no clear path back. They've cut prices to compete, which destroys margins. They've expanded distribution, which increases costs. They've launched new products, which mostly failed. The core problem isn't execution, it's that the market they thought existed, millions of Americans permanently switching from meat to plant-based protein, doesn't actually exist at the scale they needed. The company is bleeding cash. It's diluting shareholders to stay afloat. And the narrative that propped up the stock in 2019 has been tested by reality and found wanting. Number 4. Peloton. Peloton sold a dream during the pandemic. Boutique fitness at home, convenience without compromise, a community of motivated people sweating together through a screen. The stock hit $162. The company was valued at over $50 billion. Then gyms reopened. Peloton's problem isn't that their product is bad, it's that their product was accidentally perfect for a moment in time that ended. The company scaled up for a future that never arrived. They built massive manufacturing capacity. They hired thousands of employees. They spent billions on content and marketing. Now they're stuck with expensive infrastructure, falling demand, and a business model that requires continuous subscription growth to justify the cost structure. They've laid off staff. They've closed factories. They've slashed marketing budgets. The CEO who led the company during its peak was replaced. None of it worked. The deeper issue is that Peloton's competitive advantage, the content, the instructors, the community, can be replicated by competitors at a fraction of the cost. Other companies are offering similar classes with cheaper bikes. Apps are offering the same workouts with no hardware at all. Peloton is a luxury product in a category that's becoming commoditized. That's not a recipe for growth. It's a recipe for irrelevance. Number 3. Carnival Cruise Line. Cruise lines look cheap right now. Carnival's stock is still well below pre-pandemic levels. Bookings are recovering. People want to travel again. But here's what the recovery narrative ignores. Carnival took on crushing debt to survive COVID, and that debt doesn't disappear just because ships are full again. The company now owes over $30 billion. That's more than its entire market capitalization. Every dollar of profit gets eaten by interest payments before shareholders see anything. And cruising is a discretionary expense. When the economy wobbles, cruise bookings drop fast. When fuel prices rise, margins collapse. When health scares emerge, entire ships get quarantined and revenue stops. Carnival is operationally recovering, but financially it's still underwater. The stock might bounce around, but the underlying structure is fragile. You're not buying a growing leisure company. You're buying a leveraged bet on consumer spending with no margin for error. Number 2. Robinhood. Robinhood democratized investing. They made trading free. They brought millions of young people into the stock market. But free trading isn't a business model. It's a marketing strategy. Robinhood makes money by selling your order flow to high-frequency trading firms. Those firms make money by trading microseconds ahead of you. It's legal. It's also a direct conflict of interest. The company's revenue is tied to trading volume. When markets are volatile and retail traders are active, Robinhood profits. When markets stabilize and people stop day trading meme stocks, revenue craters. 2021 was perfect for Robinhood. GameStop, cryptomania, stimulus checks, and bored people at home. Revenue exploded. 2023 and 2024 were the opposite. Trading volume dropped. Crypto cooled off. Robinhood's revenue fell by double digits. The company has tried to diversify, adding retirement accounts, expanding into crypto, launching a credit card, but the core business is still dependent on people making bad financial decisions frequently. That's not sustainable. If you're holding Robinhood stock, you're betting that retail trading mania comes back and stays back. History suggests otherwise. Number 1. Tesla. Yes, Tesla. This is the one most investors will ignore, because Tesla isn't just a stock anymore. It's an identity. It's a belief system. Criticizing Tesla feels like criticizing the future itself, but let's separate the technology from the investment. Tesla's valuation assumes the company will dominate electric vehicles, autonomous driving, energy storage, and AI robotics. It's priced for perfection across 4 different industries simultaneously. The problem is that competition has arrived. Every major automaker now produces EVs. Many are cheaper. some are better built. Tesla's market share in Europe is declining. In China, BYD is outselling them. The full self-driving software that's been next year for the past 8 years still isn't here. The Cybertruck launched years late with production problems. The robotaxi reveal disappointed analysts. The Optimus robot is years from commercialization, if ever. Meanwhile, the stock trades at a price-to-earnings ratio that would only make sense if Tesla maintained a monopoly in a rapidly growing market. They don't have a monopoly. The market is growing, but so is competition. Elon Musk is undeniably brilliant. Tesla pioneered an industry. But pioneering doesn't guarantee permanent dominance. Ask BlackBerry. Ask Nokia. Ask Yahoo. The real danger with Tesla isn't that it's a bad company. It's that the stock price has detached from the business fundamentals. You're not paying for what Tesla is, you're paying for what believers hope it might become. And hope, historically, is an expensive investment strategy. Here's the part no one wants to hear. Avoiding bad stocks is harder than finding good ones. Because bad stocks don't always look bad. They come with compelling stories, charismatic CEOs, and loyal communities of investors who believe you just don't understand the vision. But the market doesn't care about vision. It cares about cash flow, competitive advantage, and whether the price you're paying today makes sense for the value you'll receive tomorrow. 8 stocks, 8 different reasons, 1 shared outcome if you're not careful. The question isn't whether these companies will exist in 2026. Most of them will. The question is whether your capital will grow, shrink, or sit dead while better opportunities pass you by. Choose carefully. This video is for educational purposes. Subscribe, comment, like and share so others can see this.